we're doing our best here to try to bring in some experts on topic, add some value back to your companies. And so this is one of the topics that we had a handful of requests to cover, and so we sought out the best possible person we could find for this job, and that's Peter Walker of Carta. Hopefully all of you or most of you are using Carta for your cap table management. It makes that job a lot easier. And would highly recommend following Peter out on LinkedIn too, where he posts some really good content about all of the data that Carta collects. If you submitted questions ahead of time, thank you for that. We have passed those along, and I think Peter will plan to answer those as well. So I think at this point we could turn it over to you, Peter, and give you a chance to kind of jump into to your presentation.
All right. Hi, everyone. I'm Peter Walker. I'm the head of insights at Carta. As Spencer mentioned, hopefully you're all familiar with Carta, but if not, happy to go into details there. But this presentation, I want to make this as useful, use this hour in the best possible way for you all. So I have a lot of slides on founder equity, advisor equity, early employees, all of these kinds of topics, but please, please, please interrupt me during this, shout out, throw it in the chat, like anything we can do to make this more interactive, I'm all for it. So with that, let me go ahead and share my screen, and we'll get started. Everyone see that? Give me a thumbs up. Awesome. Okay, so startup equity and capitalization, cap tables. So we have to start many of these presentations with a wonderful word from our lawyers. I'll let you read that all for 10 to 15 seconds here, because I'm sure you're all very speedy readers. Okay, we're good. Thank you very much. Little tiny bit about Carta at the top. Carta is a cap table company that has grown into a platform for serving innovators like yourselves. We do cap table management, 409A valuations. We help founders understand what they should pay employees in salary and equity, and all sorts of other things. And we have about 40,000 startups on the platform right now, which makes us by far the biggest single source of private company data, at least in the US, from one single provider. We're going to go through a ton of data on compensation today. If you're interested in reading more of it, we do have our latest startup compensation report for the first half of 2023 available on our website at carta.com/blog. I think it's good reading, but I am biased because I wrote it. All right, founder equity. So let's start with the real basics here, which most founders are pretty interested in. How do founders go about splitting their companies at the earliest possible stages? So first and foremost, at least within Carta, and we serve many, many, many different types of startup industries, the modal founding team size for us is 2 founders. It's the most common. But you can see that there's a ton of companies on Carta that range from 1 founder companies to 5, 6, even 8 founder companies on the platform. So there's no sort of right way to go about doing this. The most common advice that founders get when it comes to equity is that you should split equally. That's what Y Combinator says. That's what a lot of other prominent people in the startup ecosystem say about equity splits among co-founders. That is not what most founders do. The big majority of founders do not split equity equally amongst themselves. So this is the percentage by number of people in the founding team that's split equally. Yep. Is that a question? Nope. All right. 2 founder teams, only 41% of them split equally. 3 founder teams, only 19%. And then on down the line, you can imagine if you have 5 founders, it is very uncommon for each of them to receive an equal 20%. So how do they split this equity? Typically, in a two-founder company, the median percentage difference is 55-45. And again, this is just between the two of them. This is before they raise any capital, any of that kind of stuff. So 55-45 is the median split for a two-founder company. And as you grow in terms of founding size, 3, 4, 5 founders, the pattern that emerges is that there's usually one lead founder. That's the black line in these charts that I'm showing now. And they receive an outsized portion of equity. As you can imagine, that founder is also very often the CEO. Why does this happen? For a lot of reasons, one of them being that when you get into conversations with investors, they're going to want to understand the decision-making tree within your business. So there is sort of a predilection to have one person that makes the final call on many of these subjects. It's not always the case. There are wonderful teams and wonderful companies that have been built where there's equity is split equally. This is just the data that shows most people do not do that. And one of the questions that you all had asked before this talk was, how much ownership should a founder have at various points on their journey? So this is a chart that I think has quite a lot of information on it. This is the primary founder, so that CEO, that first founder, over time, as time defined by the company's post-money valuation. So up there on the left, that top bubble is a low-value company, high ownership for that first founder. And then as you raise capital, as you bring on employees, as you do all sorts of things and you give away equity over time, your ownership percentage dilutes. And so about when you hit around $1 billion, a unicorn valuation, the median ownership for that first founder that we've seen on our platform is 12%. So you go from owning half or more of the business to owning 12%. But of course, that 12% is a much bigger, much bigger pie if you're a unicorn value. I think the specific question that was asked was, how much should a founder own after a Series A? It varies a little bit based on industry, but something between 45 to 55% ownership for founders is pretty common. There are quite a few businesses where the founders will own 40% or less, but you probably will get questions from your investors if you own around 30% after a Series A. That is not a lot of your business for having only raised probably 1 or 2 priced rounds. Any questions on founder ownership? Okay. Employee equity compensation. So the main meat of the talk here, how do we compensate employees with equity? Why do we compensate employees with equity? All those fun things. So what your employees should know about grants. So taking a step back, you've decided to compensate some or all of your employees with equity. The reason you do so is that they are more likely to give their wonderful commitment and effort towards a goal in which they share ownership. And it has become basically the default, at least within tech businesses, to grant some sort of ownership to employees. That doesn't apply to every single employee, although most companies on Carta do see almost all employees have ownership stakes. But they vary quite widely based on when the employee joins, the kind of employee they are, etc. So here's a couple of the common things that your employees will want to know about their equity grants. What kind of shares they're receiving, obviously how many of them, the strike price of the shares, and we'll get into what strike price means. Some key dates, which when are they granted that date? When is it fully vested? And when does it expire?
Bring your computer, honey. We need to start working.
Sorry. And then, of course, the vesting schedule and the terms associated with that vesting. So here are some key terms. I think we can kind of skip these and we'll get into them as we go through some examples here. But to break it down very simply, there are 2 classes of stock that really matter within tech startups. There's common stock and there's preferred stock. Common stock is the simplest. It is the most standard form of stock. It is issued to founders and employees. Sometimes founders receive what's called founder shares or preferential shares, but the vast majority of founders are paid out basically alongside their employees. Common stock is typically paid out last. So if you raise money from investors and then you have a wonderful exit, those investors will get their money back almost always before any money is given to the founders and employees. That is why they are holding preferred stock. The strike price of the common stock is set by a 409A valuation. So a 409A valuation is simply a government mandate that says some third party, in this case, oftentimes Carta, will come in and make an assessment about how much your shares are worth at any given time. And then you'll use that assessment to judge how much the fair market value of those shares happens to be when you grant equity to employees. And that's important for them because they have to exercise their stock before it becomes real. So employees get common stock, investors get preferred stock. There's a little bit of mingling, but mostly that holds true. So what kinds of stock do employees receive? Well, there's ISOs, NSOs, RSA, RSU. The most common by far are ISOs, incentive stock options. Why is that the case? Mostly because they are taxed a little bit more advantageously than the rest of these options. So most of the time, you will be giving ISOs to your employees. If you become a big business, say worth close to $500 million or more, you will then probably switch over to restricted stock units. You don't want to grant RSUs upfront to employees because they come with some tax disadvantages. But as you get closer and closer to IPO, the RSU becomes more and more important. We do not see a lot of RSAs granted on the platform, so we won't be touching too much on those today. And NSOs are reserved for people like advisors and consultants most of the time. To break this out in a table, so if you left type of stock, middle, what kind of stock you want, and then why you would do it. So why would you need, or why do you think ISOs are the right thing to give to most employees? Typically what happens with an ISO is you give an employee a grant when they join the company, and that grant will vest over a 4-year period with a 1-year cliff. That is 90% or more of employees follow that same schedule. So you give them, let's say, 100 stock options, and each year they vest 25 of those options. Vesting simply means, did you remain with the business? If so, here's your award of stock. The second thing that those employees will need to do then is, okay, I vested this stock. It's sitting in my Carta account, but I need to exercise that stock, those options, excuse me, if I want to make them real. And so an exercise price is set by the 409A valuation, and they're just, you could say it's tiny cents on every share option, but those can definitely add up. So employees are going to have to make the choice once they've vested, do they buy their options or do they let them return to the pool? Just as a point of context from the market today, a lot of employees are choosing not to exercise. They do not believe in the value of the company that they're at right now. And they're saying, look, I'm not going to give any cash for these because I think they're probably worthless in the end. And that's because of all the turmoil that's happening in public markets, everything that you read about startups shutting down, all that kind of stuff. It's kind of a tricky time for equity compensation, if I'm being honest. Tax implications for your employees. The reason why you grant ISOs and not NSOs is because ISOs are typically taxed once someone sells them. And NSOs are taxed twice, when you exercise and when you sell. So it's a better deal for employees in most cases at tiny companies to be granted ISOs.
Can I ask just a real quick one?
Yeah.
The ISOs, they strike, and then they don't have to vest until there's a sunset in this, or is it just they have to take the award when they're initially invested?
No, that's a good question. So typically the vesting period is just, do the employees have the option to buy, right? Yeah. So after 4 years, they would have vested their entire stock option, and it would be sitting in their Carta account if they chose to buy it. They don't have to choose. The second part is there is an expiration on these ISOs. Typically it's 10 years from the date that it is effectively issued. So you can imagine, this just happened with Airbnb as an example. Before Airbnb IPO'd, there were quite a few employees who had been there for close to 10 years. And they were about to lose their stock because they were about to, even if they had exercised it, it was about to expire because they hadn't gone public in that 10-year period. So Airbnb had to retire some shares and reissue them. So the expiration date does come into play sometimes, but that 10-year window is generally what you're looking for those. Yes, the employee doesn't need to buy the option until it expires. Correct, Jenny. So once it vests, it's just in their account and they make that decision. The only difficulty there is if the employee leaves or is fired, they have 90 days, almost always 90 days, to make that choice about whether or not they're going to exercise their vested options. And that is tough. As you can imagine, there were a ton of layoffs across private tech over the last year and a half. So those employees were laid off, and then they had a 3-month window where they had to decide, do I give cash now for a company that just laid me off in the hopes that this stock becomes something later on? And probably they were doing layoffs because they weren't in an amazing position. So you can imagine that's a very difficult financial decision. And oftentimes employees just say, no, thank you. I'm not going to pay up to exercise, and I'm just going to let those shares return. And it's as though they didn't get any equity comp in the first place. That is pretty common. So
Peter, would you be able to walk through like a simple example and just like an idea of how much like an employee might pay for these ISOs?
yeah, so it is really, really highly dependent on when that employee joins. If you're a first 5 employee, typically your strike price, your FMV at that point is very, very little, maybe a cent or less on a share because the company isn't worth very much because you joined a very, very, very small company. So it could be that the exercise cost after 4 years for that employee is something like, $200-300. If you joined at a, say, Series B and received, a pretty decent sized grant, you could be talking about $5,000 in exercise cost, $8,000 in exercise cost, depending on what kind of employee that is. So it's really highly variable. The earlier you join, the less your strike price is almost always.
And so it's not a direct correlation to the valuation that the company raises at.
Yeah, so great question. The 409A valuations and your what's called preferred valuations, or whatever you and the investors decide your company is worth, those are 2 completely separate things that basically never talk to each other. So your investors, or you're not going to need to say, we just got revalued on our 409A. Investors don't look at that. Your investors will know that and they won't care. The 409A is simply a government process that assigns some value to your stock options, but it is completely divorced from the value of your preferred valuation. So those 2 things don't really talk to each other. Now, your 409A has to be done every year, which makes it a little different than when you're raising capital, because you're probably not going to raise capital every year. Sorry, I interrupted somebody.
I think you just answered the question. So the 409A must be done every year.
Yeah.
If you have options that are vested or not vested.
Either one. If you're planning on granting employees any options in the coming year, you need a new 409A valuation, is basically how it works. So if you're done hiring forever and no one's going to get more stock, then you don't need a new 409A. But if you're planning on hiring anyone at any time in the next year, then you do. Typically, we see companies on Carta revamping their 409A valuations pretty close to once a year. The other time that you'll do it is if you're in the middle of a fundraise. So before you raise capital from investors or immediately following, you will also do it. So sometimes it happens twice a year, but minimum once.
It's minimum once because the government requires it.
Yeah, exactly. Yep.
Do you know what the Canadian equivalent is to the 409A?
I'm not sure that there is one quite as explicitly as the 409A. I know that Canadian companies follow a similar path in terms of having a strike price on their options, but I wouldn't want to, I'm not a Canadian expert, so I wouldn't want to speak out of turn there. One of the questions, so yeah, if we walk through this on a simple basis, again, you're probably going to be granting these employees ISOs. They're going to have a strike price. Your employees will be vesting over a 4-year period with a 1-year cliff. That's, again, 90% of shares or so on Carta.
Sorry, because the 409, why do you have to do it every year if you have an ISO and there's no taxable event?
So it's a government requirement that it's being done every year because but it also is because the value of your business probably has changed over the previous 12 months. So if you were to grant a new employee that you just hired shares of the company, they want that fair market value to reflect where the company is now, not where it was 12 months ago.
Right.
Does that make sense?
Yes, I just wondered if you haven't changed, if you haven't hired any or haven't issued any more options, or well, why do you have to revalue that? But I guess it's just
So
because they tell you have to.
To be clear, the value of the FMV that's applied to the options you've already issued never changes. It's only the FMV at issuance. What happens is if you want to hire a new employee, the value of the company has changed over the last 12 months. So the government wants to make sure that you are applying the right value to those new options.
Yeah, and according to our attorneys, I mean, they are like militant about this. If we approve stock option grants a day after the 409A expired, we have to, we can't do that. And I kind of pushed back on it the last time. I'm like, oh, come on, it's 2 days. And they're like, no, it would have negative tax implications for the employee down the road. So
yes,
if you're gonna do stock options, you got to do your 409A once a year.
Yeah, they are very, very aggressive about it most of the time. And Carta runs more 409A valuations than any other provider in the country. And so we're trying to make those as streamlined as possible if you're on the platform. So one of the questions that you all had before this talk was, how do I grant employees equity? Like, what does the offer letter look like? Like what kind of language should I be using? We actually have a template that you can download at blog A Better Offer Letter, and obviously I will send these slides over after this. So the advantage of this template, and if you actually are using our compensation products, we do this digitally, so you can send a web page with all these cool interactive features. But you can break it out by base salary, commission if there is any, sign-on bonus, equity, etc. So a nice little visual for your new candidate. And then you need to give some information about the equity that they're receiving. The kinds of things you want to include, even if you don't use our template: 1, how many shares are they receiving? 2, what is the notional value of those shares? So shares times the current FMV. 3, what kind of shares are they? Are they ISOs, NSOs, etc.? And then 4, what's the vesting schedule on those shares? And again, typically that's your equity will vest over 4 years with a 1-year cliff, meaning they don't receive any equity for the first year because you want them to stay on the business for that 1 year. And then they start receiving equity, 25% of it vests the day after they've been there for 1 year. So those are the kinds of things you want to include in an offer letter, but we have a lot more in this template that you can download and you can customize it to your own needs. So a couple of questions that we always receive is, okay, well, how much equity should I be giving out then? Obviously, we have a whole product that can show you that when you get bigger. We can break it out by engineers versus product folks, and we can say San Francisco versus New York versus Austin, etc. There's a whole lot of distinctions there. But if you were just talking about the first 10 employees, this is what the first 10 employees are receiving today on Carta from small startups across the country. You focus on the right side bars there. That's the 2023 median initial grant. So the first hire at a company, so not a founder, but just the first employee, receives 1% of the company a lot of the time. And then it goes down really quickly. The 10th hire is getting less than 0.2% of the company. So it falls off very, very dramatically. You can play with these numbers a bit. There are some ranges to them that make it a little bit easier to sort of find where you are. that first hire has a big range because sometimes that first hire is the founding engineer with a non-technical team that can really command a high price. And sometimes that first hire is maybe a salesperson with a technical team that isn't going to command quite as high a price. So it's a big range. But you can see the 1% is the median, and then it sort of falls off of those black dots down the row. That orange dot is 90th percentile. So 9 out of 10 first employees receive less than 3% of the company, 3.5%. And this is just initial equity grants. This is the full 4-year grant. This is not 1% per year. It's 1% overall. Any questions on employees before we jump over to advisors? Okay, cool. Advisor equity. Advisors in this case, just to talk about it for a moment broadly, what we mean by advisor is anyone for whom you are in consistent conversation, taking advice or strategy about this business that is not sitting on your board. So these are not board members. These are just mentors, people you find at accelerators, perhaps, people that are going to be additive to the business, but because you're light on cash, you want to compensate them with equity now. I will say, if you can compensate them with cash, that's awesome. Probably they'll be happy and you might be happy if it's possible for you, but totally understand a lot of small companies don't have the cash on hand, so they're going to compensate with equity. So where are you in the advisor grant window? So you can see we have pre-seed companies, companies that have raised a seed round, and companies that have raised a Series A round. So the median pre-seed advisor grant to an advisor is just under 0.25%. 0.25% is a good sort of benchmark for you to keep in mind there, 0.25. Seed, it goes down considerably. In Series A, it goes down considerably. And of course, this makes sense because hopefully advice to a very small company is a little bit more additive than advice to a Series A company when you've already kind of de-risked the business in a lot of ways and you've already raised capital. So there's one takeaway here. It's you probably want to give your advisors somewhere in the ballpark of 0.25%. Again, same breakout as we did with employees. There are some advisors that get 1% of the company. Typically, we see that in like hard sciences, life sciences. These are maybe university professors that are bringing a lot of knowledge. It's very uncommon for a B2B SaaS advisor to receive 1% of the company. That's a lot. As you saw, that's actually founding engineer money. So that's a lot of compensation. And then it kind of goes down, as you get more mature, the grants that you'll give to advisors get smaller. How do you give this advisor grant? Typically, we see founders using this FAST template. You can find it at the link in here, but it's the Founder Advisor Standard Template, FAST. And they break it out into these levels like idea stage, startup stage, growth stage, but they don't really define what those are, so those are kind of not that useful. So just focus on the idea stage for most early startups. And again, if you're giving it to a standard advisor, 0.25% makes sense. If this is the best person ever and you love them and they're just going to totally up-level your business, maybe 0.5% or even up to 1% makes sense, but they got to be great. Like one of the things that we actually tell startup founders we see all the time is they give out equity to advisors and they're not getting any value back. It's a couple conversations over a couple months and then they just kind of fall off and boom, that's 0.25% of your company gone. So be strategic about the advisors that you're giving equity out to. Typically advisors, their grants will vest over a 2-year period. Always have a vesting schedule on advisor grants. Always have a vesting schedule on founder grants as well. Everybody gets a vesting schedule, no matter who you are. And the reason for that is you could come up after 3 months of working with an advisor and it's just not working out. They're not who you thought they were. And if they don't have a vesting schedule, they walk away with their whole equity grant, Whereas if they have a vesting schedule, you can keep some of it, you can terminate the agreement, all that kind of stuff. So always have a vesting schedule in all of these equity grants. What else? Oh, a lot of people also ask, okay, I understand that I should have a vesting schedule, but instead of just saying 2 years of vesting, I'd like to say you get equity based on specific performance criteria, you know, number of introductions, number of new hires from this person, et cetera. That's okay. You can do that for sure. If you do that, you got to be really specific about what the criteria are for which you're compensating this investor. So it can't just be a line in the document that says, helped me hire new folks. It has to be, this person helped me hire 2 specific new hires in this part of the company, and they were instrumental in getting me those in. Like, it has to be very specific, or else you kind of get in fights with your investors about whether or not they've hit performance criteria, and those are no fun. Nobody wants to be in those fights.
Also, probably should not tie that to helping raise capital.
Agreed, yeah.
Here, one
Capital
quick
is-
question on the employee,
Sure.
to the employees. So that 1% higher,
Yep.
are they getting issued new options again the next year that would be another 1%, or how does that look?
No, that 1% is their initial 4-year grant. You know, when it comes to refreshing equity, typically what happens is you give an employee more equity than their initial grant in 2 places. 1, when they get promoted, if they're crushing it. And 2, when they run out of that initial 4-year grant, you know, the reason you gave them equity in the first place was to incentivize them as an owner of the business over time. So if they don't have any equity, it is more likely that they leave. So you might want to consider doing a refresh grant after their 4-year ends, maybe even like a year before their 4-year ends, so they're kind of continually and continually incentivized in the business. But it's not as though they get a new grant every year. That's pretty rare.
Thank you.
Yep. Okay, so fast yep.
Sorry, one more quick question on the fast. So again, you should be setting an exercise purchase price when you sign the fast?
Yes, so because you are giving out equity here, you'll probably, advisors typically receive NSOs, which definitely have a strike price, just like the ISOs that you gave to employees. That strike price is going to be set by your 409A. And really this just comes down to, when do you get a 409A? It's basically whenever you start giving equity to anybody. It just makes your life a lot easier if you have one. If you grant advisor equity without a 409A, it's possible, but you're going to run into some annoyed lawyers later on in your life. So I would get a 409A. Usually have a value to the stock options that you're giving out is basically the general rule there. And again, advisors get NSOs, not ISOs, because I mean, they're taxed differently. It's a different kind of qualified stock. But overall, the idea here is to have an idea about what each share of this is worth nominally, so that your advisors and your employees can make good decisions when they need to exercise later on. There was a question that was submitted beforehand about, okay, I understand that we give advisors stock. Do we also give board members stock or equity? The answer is yes, typically. Here it's a lot more like sometimes cash, sometimes equity. It's a little bit more of an amorphous space than advisors. And probably in the pre-seed and early on, you don't really have a lot of board members. Maybe you have 1 or 2 other than the founders, because you haven't taken on any investment. Typically what happens is when you raise a round of financing, an investor from that round will join the board in most cases. So your board will grow as you raise more capital. You do grant equity to these board members. You can see that it's actually it's a little bit higher than the equity granted to just regular advisors. And the board member equity typically vests over a 4-year period. These board members are what it means to be an independent board member is just you are not an investor, nor are you a founder of the company. You are someone else that's brought in. That becomes more common as you get bigger and bigger. So you shouldn't be granting 5 people board member equity when you're a tiny company. You keep those boards pretty small. But that was a good question. Whoever submitted that. That's not one we usually get. So good thought. Last bit here, we're talking about equity and granting it to employees, advisors, board members, etc. The other people that you'll give equity to, obviously, are investors. When you do that, you'll do that in mostly these pretty easy ways. So if you're raising a priced round, like your Series A, you'll give investors preferred stock. You'll have a negotiation. You'll put a formal valuation on the business. It's a lot of back and forth. You'll give out preferred stock. When you're using convertibles, those are basically contracts that explicitly avoid the need to put a valuation on the company. That's you and an investor saying, hey, look, I would like to have this investor in the business, but my company's pretty early on and we don't really want to put a value on it yet. So why don't we just say, you give me some money now, and whenever we have that big conversation with the preferred investor, you'll convert at a similar term to that new investor later on. So those are typically convertible notes or safes, simple agreements for future equity, which Y Combinator has made very, very popular here in the Valley. So those are typically the ways that people raise their first initial capital, most of the time on a safe or on a convertible note. And then they wait a little while, they grow a bit bigger, and then they do a preferred round later on. A little bit more on safes and convertible notes. A convertible note is simply an agreement between you and an investor, and the investor says, hey, I'll give you $100,000 today, and then whenever you raise the price round, I will convert into equity at such and such terms. And the only difference between these two things, safes and convertible notes, is that a convertible note comes with an interest rate, so it's an actual debt instrument, and a safe is interest rate less. It's just an agreement, and it's a little bit more easy for many founders. So more conservative investors are probably going to default to using convertible notes. But about 82% of all the pre-seed financing we see on Carta today happens through safes. So if you're not familiar with the safe, definitely good to check it out. We've got a ton of information on that, and we can be helpful there to make sure you're using it correctly. You can actually issue them through the platform for free to your investors for us. So if you're not familiar with the safe, definitely good to read up on that, because it's probably how you're going to be raising your initial funds. Try to think. Got a lot of resources left here, but hopefully, yes, I left a bunch of time for questions here at the end. Yeah, what can I be more helpful with?
In your suite of products, you had something listed, I think it said lawyers, and what, can you put up that last slide just so we can just see it?
Yeah. Sorry, shouldn't have done that there.
Because I'm not familiar with Carta, and we did not use you guys. So
No worries. Or I should say, how dare you is a better response. Yeah. Let's see. So this is a list of a lot of, again, we'll send this deck over, but a lot of resources on all sorts of things. We've got a resource center for founders. We go through option pools and dilution, safes, all sorts of stuff. The biggest ones for you are probably, first and foremost, Carta launch is completely free for all companies until they've raised $1 million. So that's like basically our entire cap table software. You can issue equity, you can raise on safes, you can have data rooms that are private that you can share with investors, all sorts of really good stuff. And it's, again, completely free until you've raised your first $1 million. The others, products, Carta deals with a lot of different things up at the top. Probably the most important for you all is the 409A valuations. So whenever you're ready to get a 409A and starting issuing equity, Carta can help you there. Cap table management, just who owns what of your company. And then issuing and accepting security. So your employees will get a Carta login if they use Carta, and you can they can track their own equity there. They can exercise there. They can get a hold of all the vesting schedules and stuff, so you don't have to manage that for them.
Hey, Zach here from Tractor Zoom. I've got a question on restrictive stock. I know
Yeah.
you mentioned the vesting schedule typically for options.
Yep.
With restrictive stock, the employees are paying for the stock on day one. What do
Yep.
you typically see on vesting schedules for restrictive stock?
Yeah, so if you're using an RSU, I can just use Carta as an example here. Again, RSUs are mostly issued to later stage private companies or public companies. RSU is actually the same thing that a Google employee today would get from Google. And the reason for that is because the valuation is high enough and the business has been de-risked, it is safer to assume that that stock unit is going to be worth something in the future, and therefore you can pay taxes on it immediately, as you said. So typically the vesting schedules though are the same. It's a 4-year vest with a 1-year cliff. I'm just speaking about private companies now, not about the publics. So those are typically the same, but your employees will there's no exercising that happens with an RSU. It's just as soon as you hit the vesting criteria, you own the stock and you pay taxes on that ownership. So we don't, as an employee of Carta, I have RSUs, I don't have a choice. I don't get to choose whether or not to exercise. Whenever that date hits, I pay taxes, which is why that would be kind of weird to do for a company that may or may not be worth anything in the future, which is why really small companies don't generally do that. Well, that's a good question though, Zach. Any other burning questions around equity or anything that Carta could help you with here?
What is it what is the expense from using Carta when you're above $1 million? You said $1 million below it's free. What is it above $1 million?
Depends on how many stakeholders you have in your company, so employees and investors. Typically, it's something like $2.5 to $3.5K annually. And that includes the price of one 409A valuation, which you would need to pay for from an external person regardless.
What was the last sentence again?
You'll need a 409A every year, as we've spoken about. So that just kind of comes along with all the packages.
Well, Peter, thank you for your time and presenting all of this information. I know it's kind of I think it's kind of a complicated topic and kind of a sensitive topic at the same time. So I'm a little surprised we don't have more questions flying around, but understand why maybe you're holding back also all of our teams here.
It's all good. If there are questions that pop up afterwards, you can always find me over email or on LinkedIn. Happy to, if there's some sensitive ones that you want to talk about specifically, that's totally fine.
Sure. Well,
I've got more of a comment than a question, Spencer. I just think that this session as part of the ag launch or any accelerator would be valuable, because had I known that Carta existed and I could have used their services for free when I started in the ag launch, I would have just started with them. So, and I know that at least in the 2021 cohort, we have a 10% option pool set up aside. And the person at Ag Launch that required that, we never did understand why that was there. So I would just really strongly encourage you to help out the other Ag Launch people as they're coming in with this type of presentation.
Well, great. So thanks for the feedback, and we're trying to create a better founder experience, which is why we've got you all on here today. Peter, I think that does open kind of a something that we didn't talk about with like these employee stock option pools.
Yes.
Do you want to maybe
Yeah.
talk about what you're seeing there?
Sure thing. Let me throw something up real quick for you. So employee stock option pools. These are, it sounds like there was some sort of requirement or something about 10%. That makes a lot of sense. So what an employee stock option pool is it is a portion of the company equity that is reserved for employees. And the reason that you would reserve it ahead of time instead of just saying we're going to grant employees equity as we go is because it is dilutive to grant equity as you go, and investors want to know upfront how diluted they will be. Or in many cases, they do not want to be diluted. So they will ask that you have a pool set aside for employees before they invest, and they will not be diluted by that pool. Typically, 10% is a great starting point. We see a lot of companies start at 10% when they are quite small. But you can see the black dots here. This is post-money valuation, and this is the median percentage of company equity that's reserved for the pool. So this is not used. This is just the whole pool, whether or not it's used. And it grows. It starts at 10 and then it goes up to maybe 12 or 13. Then it kind of grows slowly until you get to be a unicorn and you have about 20% of your company value reserved for employees. One thing that we see founders do sometimes, if you're in discussions with a venture capitalist, they will say, hey, I'd like you to reserve 18% off the bat. You should push back on that. You can always expand the pool. The reason they are doing that is because they do not want to be diluted, but that is not market. So if a company is worth less than 100 million, reserving 20% of the pool is too much. So just as a piece of advice, 10% is great. You'll pay out of that pool, and then you'll refresh that pool as you need more capital, or excuse me, as you need more equity to incentivize the next set of hires that you want. So sometimes you don't even set aside until you start into conversations with investors. But it's, a lot of accelerators and other places will have you set aside 10%. And I think that's actually pretty reasonable. This report that I'm showing here, again, that's the report on our blog where you can get all this information about early employees, about advisors, about board members, about compensating if you're granting equity to people internationally, all sorts of good stuff in our comp report that recently just came out.
If you have options that were set aside for an employee and that option has expired, what do you do with those options? Those that have been set aside?
Yeah, those, if an employee option grant expires before it is exercised, it simply returns to the pool. So you could grant it to another employee if you so chose. In fact, this is sort of a dark pattern that we see with the equity exercise window being 90 days. A lot of founders count on that and they say, look, I don't think a lot of my employees are going to exercise, and I don't need to expand my pool. That's not a great move, I don't feel super happy about that, but it's definitely something that happens a lot, is that unexercised options simply return to the company and you can use them as you will.
I hope you all noticed that that little piece of advice that can make you all a couple extra $1 million for yourself when you negotiate your next financing round
Yeah.
that Peter mentioned at exit, of course. But so thank you for that, Peter. That's money in your pocket, future founders, exited founders.
For sure. Speaking of millions of dollars in your pocket, we didn't touch on this, but perhaps we should have. QSBS, qualified small business stock. This is essentially, I wouldn't call it a loophole, but it is a part of the tax code that if you follow certain instructions can be incredibly beneficial for you as founders. You can save tens of millions of dollars in taxes. So what happens is that it is a tax benefit, tax break, however you want to say it, that applies to people who invest in very small businesses. You can potentially exclude 100% of the tax on any capital gains if you follow these steps. So we have a ton of tax advisors that work at Carta. There's a lot of rules for who qualifies as qualified small businesses and don't. I'm almost certain that every single one of your companies qualifies. You have to be a C Corp. You have to have less than $50 million in assets. And you have to use those assets in the trade that you are applying. So that mostly applies to everyone that we come across. Then what happens is you simply attest from an attestation letter from someone like Carta that, yes, you fall into this criteria, and then you get this tax benefit for yourselves and for your early investors. And again, if those shares ever become worth a lot of money, imagine not paying any capital gains on them ever. So if you're not familiar with QSBS, I highly suggest that you do so. I can drop this actually into our chat right now. And oh no, that's incorrect. Well, I will follow up with that anyways. But QSBS is it feels just kind of like a pedantic set of instructions. You have to go get an actual attestation letter from somewhere. This seems like very old-fashioned and whatever, but it is worth hopping through these hoops because if you do have a major outcome, you could save lots and lots of money with this.
Yeah, and thanks again for that too. So I guess maybe we should have started with this, but if you all haven't considered this before, I actually think that equity comp is like one of the secret like superpowers that a startup has. You can use it to identify kind of like the missionaries versus mercenaries when you hire them. It allows you to compete with other companies that do not issue equity, and it allows you to compete with the big startups that you just can't compete on salary with. So I have always been a big fan of this, and I kind of think that it's almost like a missed opportunity for any business of any size. But Peter, would you echo similar sentiment, or have you seen data that would say otherwise?
No, I mean, I completely agree. You know, Carta exists on the back of creating more owners for employees. I think the point about competition is a good one, especially if you are in a space with a lot of non-tech companies. Ownership can be a really easy way to stand out. And then, you know, the sort of standard tagline in Silicon Valley is, of course, that the earlier you join a startup, you're taking on more risk. You have a little bit of ownership in the game, and that can result in life-changing outcomes. I will say, obviously, it doesn't usually result in life-changing outcomes, right? We're all aware that 8 or 9 out of 10 small startups will end up closing up shop, and that equity will not be worth anything. So I don't want people to think that equity should be used in lieu of paying a good wage. But it does offer this ownership incentive to everyone in the business where it really aligns everyone to the same purpose, the same goals, which is why some of those vesting schedules can be 4 or 5 years. So we are deep believers in equity, as you can imagine. We all are owners in Carta. And when it works, it really, really works.
Well, awesome. Thank you for your time today. Founders, I think we're gonna kind of wrap up here. I will stay on for a little bit if you have any feedback that you want to provide. We are looking for ways to continue to add value to your companies. And just a shout out to Peter again. He's been super available. So if you have questions that you think you want him to speak to directly, definitely find him and send those out. He's been excellent. And thank you all for joining us too.
Thanks, y'all. Good to meet you.
Thanks, Spencer.
Thank you.